Hello and welcome. I'm Blair Blackwell, and this is the Daily Market Brief. Let's catch up on what's moving in markets today.
Good morning. It's Thursday, February 5th, and this is your New York Open Prep. Today, a cooler tone from U.S. labor data. Europe's central banks hold steady but sound cautious, and corporate headlines split between weak consumer demand and stronger refining margins as oil eases. In the U.S., job openings fell more than expected, with the JOLTS report showing about 6.5 million vacancies versus a 7.2 million consensus. Initial jobless claims also ticked up to 231,000, above expectations, a reminder that hiring is steady but not hot. The Labor Department's main employment report has been pushed to next Wednesday due to earlier data delays, so markets are reading these interim signals closely. Across the Atlantic, the European Central Bank left rates unchanged, and while stressing it has no exchange rate target, President Christine Lagarde noted that a stronger euro would help bring inflation down, and that uncertainty could weigh on demand. Economists argue it's not a non-event, with attention on how quickly disinflation progresses. In the UK, the Bank of England also held its rate at 3.75%, with a close split and a dovish lean that hints cuts are getting closer. That tone pressured the pound, and we saw it in price action, with sterling sliding against the yen. In emerging markets, analysts expect Mexico's central bank to stay cautious and keep rates on hold, a stance that tends to support the peso. Meanwhile, strategists say the yen remains weak, despite improved fundamentals, underscoring how policy and yield differentials still dominate. On the corporate side, Peloton shares tumbled more than 20% after a weak holiday quarter and lackluster demand for new products. Sweden's Volvo Cars is on track for its worst day on record, citing tariffs, currency effects, and softer demand. And in energy, India's largest refiner reported a fourfold jump in profit as lower crude prices widened refining margins, a reminder that cheaper oil redistributes earnings across the energy value chain. Turning to markets, softer U.S. labor signals are supportive for risk sentiment and slightly negative for the dollar, while the ECB's steady hand keeps the euro story balanced, with a subtle disinflation bias. The Bank of England's dovish tilt weighs on sterling. Oil's recent softness helps refiners and could cap an upside for producers. Looking ahead, the calendar is relatively quiet after claims and JOLTS, with the main U.S. jobs report now due next Wednesday. Keep an eye on central bank commentary and any updates from Mexico's decision-makers. You should be watching the British pound against the U.S. dollar for a downtrend as the Bank of England's dovish vote filters through, and sterling against the yen for follow-through on the downside. Keep an eye on the euro against the dollar, where a steady ECB and talk of disinflation could nudge it modestly firmer. The Mexican peso versus the U.S. dollar may hold a firmer tone if Banxico stays cautious. And watch Brent and WTI for a soft bias, with refiners benefiting from any further easing in crude. The takeaway, markets are leaning into a gentle slowdown and patient central banks, but the path still depends on the next round of labor and inflation data.
That's it for today's edition of the Daily Market Brief. Thanks for listening. I'm Blair Blackwell. This podcast is for informational purposes only and does not constitute financial advice, trading recommendations, or investment guidance.